Let's look ahead to the second quarter. Are corporate profits bound to reflect the impact of $100 oil? Lee, I want to go to you first. Lee, what's your take? I mean, is this the first quarter where we see the reality of it?
Well, I think to some extent, I'm less concerned about the general market and, having some softening of earnings. What I'm more concerned about is how I'm going to make money from it. I think we should look at is investors should spend a little bit more time looking at what got hurt on the peripheral. Look at something like a Chesapeake or a CSX. These companies did get hurt throughout the quarter with their share prices that got discounted. So I think investors need to, instead of worrying about this, they need to go head on, get straight in there, and start looking at some of the energy companies that did get knocked down, that did go down, as opposed to worrying about all corporate profits. Q4 was far worse. Q4 we had serious credit problems, and those are over now. So I think natural gas softened it because it's so cheap, and I also think that the loosening of credit markets is going to make up for some of this $100 oil business.
It sounds like Paul, he's saying look for smart energy plays as a reaction to this.
Yeah, I think there's definitely some sense to that. I mean, clearly rising oil prices are going to hurt some of the transportation companies. It's going to hurt some consumer companies, other companies that rely heavily on commodity costs as a big portion.
So don't play the market that way.
I don't know why you'd want to look at heavy natural gas plays and things of that nature. Clearly, the trend is not in your favor. So we're emphasizing financials. They're working. We think it's a strong area of the market. Obviously, everyone loves technology at all times, but right now it's actually valid. Corporate budgets, they're still spending money on tech. Outside of those two sectors and healthcare, there's really not a lot to like. We are studiously avoiding anything industrial. We're avoiding a lot of the materials, and we want as little exposure to China as possible.
So, Lee, I wanted to bring you in on this point of what if we have the trifecta disaster zone? What if we have Eurozone deteriorates further, China, hard landing, oil, 120?
Very simple, because that is kind of how we always are trying to position for a worst case scenario and then try to skim as much money doing it as we can. The first thing we did with all of our, about a month ago, we took all of our emerging market positions. We usually use ETFs for that, and we swapped out of the major emerging market index, and we found you can find them out there. There's little ETFs that don't have really any significant BRIC exposure, because remember, it's not just China, but then you have Brazil that feeds into China, and then with Europe, you've got Russia that's providing the energy. India, we'll just not talk about that for a second. So if you can find emerging markets that are not involved in the BRIC trade, you can insulate somewhat, not on panic, but fundamentally you can insulate from China, insulate from Europe.
What about housing in terms of where it stands right now? We're not going up, we're not going down. We've seen some softness and then some. We don't know which way to go.
The fun thing about following housing is that no one's ever right, no one's ever wrong, because the picture is so mixed, the data is so confusing, nothing confirms anything else. So rather than get too far out into the weeds, I would tell you that even if there is another few percentage point drop in prices on a national basis, that's not the story. The story is that multifamily homes are doing great. Not necessarily the best thing if you want housing market to bottom, but it's a reality. Rentals are hot. And the way to play that is with Home Depot, new 52-week high pretty much every single day this year. Look at Valspar, look at Sherwin-Williams.
I recently wrote a column about the quote-unquote kind of fake housing recovery. If people look at the home builder ETF, the XHB, and they look at that as evidence that housing is really improving, it may not be that the housing market's improving, but that people that are in their own house or renting just want to improve where they live. Because as you point out, Home Depot's doing really well, and that's in this ETF, even though it's not a builder. Bed Bath & Beyond, Williams-Sonoma, these are companies that can still do well even if the housing market is not doing great.
The example that you brought up, I'll just bring it all full circle and wrap up. The example that you started with, what if we have the trifecta, Europe, major recession, China, major slowdown, and oil at 120. Those three things could never happen simultaneously. If you get a crashing economy in Europe and China or China, you're not getting $120 oil, you're getting demand destruction. So you would never actually see, unless there's a war.
If Iran wants to
I was just going to say,
but I'm saying economically speaking,
has there ever been peace in the Middle East?
But we don't make investments based on whether or not Israel's going to strike Iran. That's not
something we got to think about.
We have to think about it, but we certainly can't build portfolios that way.